I'm Rob Berger. Hope you're having a great evening. This is our live Q&A, where for an hour and a half, I just let you guys pummel me with questions, and I do my best to respond to them in at least a somewhat helpful, useful way. I started to say intelligent way, but maybe that ship has sailed. I don't know. Can you see all my mints over here? See, I see, I think, a bigger screen in my monitor than you actually see. Maybe not. Anyway, if you can give me a thumbs up. I'm just reading something here, but I hope if you can give me a thumbs up that you can hear and see me, we will get this party started. Oh, there we go, Rap Freak. Nice to have you back. I got 3 thumbs up. So I was at a conference this week. I've been to this conference since 2011. It's called FinCon, and it's just a lot of fun. It started out sort of as a personal finance bloggers conference for the most part. But that was back in 2011. Since then, you've got podcasts, you've got YouTubers, you've got TikTokers, authors. It's a lot of fun. And so that was a good time. I spoke. I did a presentation on YouTube, this channel. I talked about all of you. I said, we do a live Q&A every other Monday. And I think, to the extent that this channel has had some level of impact on people's lives, positive, I should clarify. I think the live Q&A is a big part of it. And it's a lot of fun for me. So, that's good. I do have a question, sort of my opening monologue that's going to be very short tonight. And I see some of the questions that have already come in, which we'll talk about. But I want to start with a Q&A. And here's the question I want you to answer for me if you can. I'd actually typed it out, but then I lost it here. So here's the let me set it up first before I start the Q&A. You may recall, if you've watched the video I did, is that when you're in retirement and you're paying a financial advisor, say, we'll just assume 1% of assets under management to manage your investments, you've got to factor that in when you think about your withdrawal rate. You can't just assume a 4%, because when Bill Bingen did his research, it assumed no investment fees. And so if you actually plug in 1%, it reduces the safe withdrawal rate considerably, typically down to about 3.5% from 4%, which may seem a little odd. It's like, well, why doesn't it reduce it by 1%? But remember, the safe withdrawal rate represents the worst case scenario, which in Bill Bingen's research was of retirement starting either in 66 or 68, depending on how you crunch the numbers, but mid to late 60s. And so with those retirements after 30 years, you make it barely at 4%, but you're basically out of money. So if you add in the 1%, those are still the bad years, but you've got to reduce it to 3.5. And the reason you don't have to go all the way down to say 3% is because, your balance is going down throughout that retirement, because that was such a hard time to retire, mainly because of the inflation of the 70s and early 80s. And so, yeah, it's still 1%, but it's a smaller and smaller and smaller amount. If you were to look at, say, a retirement where, like, let's say retirement in 82, well, actually, we can do it. Let's do it. Why not? I haven't even got to my question yet. So I think we can do it here. Again, I'm still getting used to this. I like what they've done to this site. They've changed it. This is ficalc.app, but I'm still getting used to it. Here, I'll throw there we go. There. Okay. So what we can do, we got $1 million, right? And we can start with 40,000 withdrawal. And I think, yeah, we can add fees right here. So let's not add the fees right now. With the data that they use, 4% rule, you can see here, it's not quite 100% success rate, but close. And they must be using a little slightly different data than Bill Bingen used. Plus, you've got the stock bond allocation. We can actually make this. Let's make this 75, this 25, which is bonds, and cash 0. It probably doesn't change this much. But in any event, so 96.7%. If we let's drop this to, or increase the fees to 1%. And it doesn't drop a ton, but it drops enough, right? And so if we were to try to figure out, well, what would be the safe withdrawal rate? Let's go back down to 35,000. Yeah, we're still not quite there, but roughly 34. Let's go down to 34. We're pretty close. Now, if we look at all of these, if we went to a year that was successful, And by that, I mean you had a lot of money left over. That 1% could actually affect you more than 0.5% in the withdrawal rate because your balances are going up, like this one, right? So we could compare and look at both numbers with and without fees. I'm not going to do it. You can try that on your own if you want. But the point is, how it's going to, that fee is going to affect you kind of depends on what the market does during your retirement. But we know it's going to affect you a lot no matter what your retirement looks like. So what's my question? Well, my question for you tonight is came from a viewer who is not paying percentage of assets and not paying an AUM. They're paying a flat fee. And in this person's case, it was $6,000 a year. And it's not coming out of the portfolio. It's like, I guess they're just paying it out of their checking account. So my question is, will a flat fee, I'll call it advisor expense, reduce the safe withdrawal rate, the SWR? That's the question. And why can't I? Hang on. I got to do this all over again. Hang on. I'm going to do this as a poll, not a QA. And I just have yes or no. What do you think? By the way, I don't know how each individual answers. You have you're totally anonymous. I can't see who answers. I don't know who answers yes or no. Will a flat fee advisor expense reduce safe withdrawal rate? I could have probably worded that better, but we're going to go with it. So I will let that run for a little bit. And while it's doing that, I'm going to go to the questions. Then I'll come back and talk about it. By the way, Noreen, I see your comments in the chat. I am grateful that you are here tonight. All right. The first question, if you want me to cover a topic or ask a question, tag me in your question. But I see this one from Reem. It says, what are your thoughts on the new iShares LifePath Target Date ETF? Will be tax efficient in an individual brokerage account? No, I don't think so. So BlackRock, which is the company behind iShares, was at the conference I was at. I spoke to a number of folks from BlackRock. I may be going up to New York in November for a little event they have. It'll be kind of fun, I guess. But let me just show you. This is, Target Date Retirement Fund. Here's an example. iShares LifePath Target Date 2045. It's an ETF. It's inexpensive. I think Vanguard's is what? 8 basis points. So maybe this is a few points higher, but still inexpensive. They've just launched it. They launched it, I think, while I was at this conference. In fact, yeah, because the first day I talked to them, they couldn't tell me anything about it. But the thing is, if you drill down into the holdings, let's see here. So it holds other ETFs, and I understand that ETFs can be tax efficient, but it holds some fixed income. Now, it's not a huge amount. It's 10%, right? Well, I'll just tell you, it is 10%. By the way, it's 10% for the 2045 fund. It's obviously going to be different depending on, the closer you are to retirement, the more fixed income it will hold. And we can look these up on Morningstar. This is the same 2045 fund, and we can see it's got 10 or 11% in fixed income, which it's going to pay interest. It's going to be taxable in a taxable account. But here's the other thing. As you age, in this case, closer and closer to 2045, it's going to start moving more and more into bonds. So I personally would not hold this or any other target date retirement fund in a taxable account. So yeah, there you go. Let's take a look. So far, we're at, will a flat fee advisor expense reduce safe withdrawal rate? 75% so far have said yes. 25% have said no. We'll let that run a little longer before I give you my opinion. All right. So yeah, that's the question we just covered. Kat wants to know my takeaways from the Bogleheads conference. Well, I'll be honest, the best part of the conference for me was meeting many of you. Got the chance to go out for dinner, missed some folks for dinner, which I was upset about. Sonny and VJ in particular. I don't know if I missed anyone else for dinner. I might have. But just meeting folks, talking to them, getting to know them, what's going on in their world. that's probably the most fun part of the conference for me. I'm trying to think if there were any big takeaways for me at the conference. I mean, to be honest, a lot of what's covered is the kind of stuff that we talk about every other Monday and that I read about all day long. So I can't think of any sort of aha moment I had during the sessions, but they were great. Wade Pfau was there. It was good to hear his thoughts on a number of topics related to annuities and safe withdrawal rates. Mike Piper was there, who I've known for a long time, and I didn't get to say hello, which probably my own fault. But I did get to chat with Rick Ferry. I got to meet Paul Merriman in person for the first time, and he and I had a chance to chat. So that was good. They probably announced where next year's conference will be, but I missed it. So I don't know. Maybe you guys know. So yeah, it was fun. I don't know if I'll go next year. I guess partly depends where it is. I would like, we need to figure out maybe a good way to, maybe I should plan like some trips to places where we can all hang out, bigger cities or something. I don't know. We'll see what 2024 looks like. All right. What do we got next? So Noreen wants to know what currency hedged international bonds are. Vanguard suggested I invest in them. Well, so if you own any investment that's denominated in a currency other than US dollars, right? Doesn't have to be another currency. I mean, you could hold gold, you could hold crypto. That's the thing about crypto. They were at one point promoting, maybe they still are, this staking where you can earn interest on your crypto in crypto, but and there are companies that will allow you to earn interest on your gold. They usually pay you in gold, but you're accepting the risk that gold will go down while you're sort of locked into this position, right? So that when you go to translate it, back into dollars, you're getting fewer dollars, right? And so that's the same idea. If I own a bond issued in euros, while I own that bond, I'm taking the risk that dollars, when I go to sell those bond and take those euros and convert it back into US dollars, that they won't be worth as much. The dollar will go down relative to whatever the other currency is, right? So one way to deal with that, one way to deal with it is to just shrug your shoulders and say, yep, I'm taking the currency risk. Sometimes it'll work out for me, sometimes it won't. I'm a long-term investor. I'm okay with that. I don't think that's at all unreasonable in my opinion. Another way would be to buy a bond fund that hedges that currency risk. And I don't know any of the details behind how they do it. I mean, conceptually, I could think through it, but what I do know is it costs some money. It's not free. You can't hedge that kind of risk for free. So there is a cost that's going to be taken out by the fund to hedge that currency risk. That doesn't mean it's not worth it. My approach generally is just to stick with US denominated bonds in a total bond fund, maybe some T-bills, tips. I published a video today on a tips ladder. You don't have to worry about currency risk. So my question to someone that says you should invest in international bond funds that hedge the currency risk is, why invest in them at all? Now, there can be a reasonable answer to that, right? You can say, well, just more diversity. But for me, what I want out of my bond fund, I'm comfortable with US bonds. Although there are days when I look at our government, and I think maybe that's not the best way to go. By the way, you can have currency risk with equities too, right? And you just have to dig into the details of the fund to figure out how they deal with that currency risk, if at all, right? Yeah, okay. Mr. MM. Who's Mr. MM? There's Mr. Money Mustache. I guess that's okay. Maybe is that Mr. Money Mustache? Anyway, calls Betterment's robo cost less than zero due to tax loss harvesting, which would make it a no-brainer over a 3 fund. Do you agree? I do not agree with that. I don't know if Mr. Money Mustache said it or if it's someone else. Well, first of all, we're talking about a taxable account, right? Because in a retirement account, an IRA, it's not going to do you any good. But the studies that I have read, and this makes intuitive sense to me, and I've given this a fair amount of thought, is that unless you're putting a lot of money into the taxable account every single year, the benefits of tax loss harvesting are eventually they're going to eventually reduce to almost nothing. Think about, let's say you put 100 grand, whatever, in Betterment, and some of those assets are going down in value, some are going up, and so they start to do some tax loss harvesting. But let's fast forward 5 years from now or 10 years from now. Unless we've had a brutal market, eventually you're going to have gains, and you're just not going to have losses anymore, right? They will already have harvested whatever meaningful losses you might have had. And so I don't see tax loss harvesting as having this great ongoing benefit. And that's also why I'm just not a fan of direct indexing. I mean, I know in theory it sounds good, but what you're going to end up with if you use, say, a Schwab or Fidelity, you're going to end up with hundreds of positions in this taxable account. I think over time, and what I've read puts it at about year 5, the benefits of tax loss harvesting are going to have diminished significantly. And then you'll end up with this ridiculously complicated portfolio in a taxable account that you're stuck with, along with the 40 basis point fee from Schwab or Fidelity. So I think tax loss harvesting in and of itself, of course, could be quite useful, and you can do that on your own. But I just am not a big believer in that. For most people, tax loss harvesting has this great long-term benefit. That's my take. Feel free to disagree amongst yourselves. Okay, let's go to the poll. 77% say that the flat fee advisor expense will reduce the safe withdrawal rate. 23% say it won't. So here's my take on it. Let's make the argument that it won't reduce the safe withdrawal rate for a moment. The theory would be you've got all your investments over here with the advisor, and it's doing its thing, and you're not taking any money out of that pot of gold to pay the fee. The advisor charges you $6 grand a year, so you come over, I guess, to your checking or savings account and pay out the $6,000 fee. Now, in that sense, you could argue the safe withdrawal rate hasn't been affected at all because you haven't touched your pot of gold. The problem, though, it seems to me, is twofold. One is, if you didn't have that fee at all, you could take the $6,000 and add it to your pot of gold, okay? And you could invest it and earn returns. So in my mind, it doesn't matter where the fee comes from. It's going to reduce what you can otherwise spend in retirement. And that gets me to sort of the second point that's related. I think the best way to think about fees, and including with retirement, is not to think about, will it reduce your safe withdrawal rate? But rather, just to translate it into dollars, and of course, if it's a flat fee, like a $6,000 annual fee, that's easy to do. If it's a percent of assets, whatever that percent is, and that's true if you're paying high expense ratios, if you're paying an investment advisor fee, translate everything to dollars. So here's the deal. You can still take, let's say in this hypothetical, 4% in year 1, let's just say, use that, and adjust it for inflation. However, out of that, we'll call it $40,000 in year 1, assuming $1 million portfolio, you got to spend $6 grand. You got to chuck it over to the advisor, right? So you can look at it as reducing your safe withdrawal rate, or you could say it's not reducing my safe withdrawal rate, but I can't spend all of my safe withdrawal rate because I got to give it to the advisor. And you can see with my head going back and forth, it drives me crazy. All right. And this is decaf. All righty. So the idea that an advisor will say, oh, don't worry, it's not going to affect your safe withdrawal rate, it's a flat fee and it comes out of your checking account, is nonsense to me. That's my opinion. All right. We'll end that poll. Okay. By the way, that doesn't mean you shouldn't pay an advisor. But there are plenty that you can get for a reasonable fee. I think $6,000. I mean, I don't know if you had $10 million invested or something, but that's the other thing. It shouldn't take an advisor any more work to invest $10 million than to invest $500,000. And they will say, yeah, but your estate and planning and your taxes, that's more complicated. Fine. I'll do a flat fee for a financial plan. We'll update it once every 5 years. Let's see here. This one comes from DCS. On a practical level, how to remove funds for living expenses plus taxes. If you need $50,000 per year, do you remove $65,000 and put $15,000 immediately in a high yield savings until tax time? Well, so you definitely, the short answer is you do need to think about how much do you need after taxes, right? So in this case, we'll assume $50,000. And then you have to figure out where it's coming from, because that will, of course, determine the taxes that you need to pay, right? So it could come out of a Roth, you don't have any taxes. It could come out of a traditional and everything is taxed as ordinary income. It could come from dividends in a taxable account, and it's all taxed, but it's qualified usually. I guess there could be some exceptions, but usually qualified with dividends, which mean you'd get long-term capital gains treatment. Or it could come from selling shares in a taxable account. And again, we'll assume you've held it for at least 12 months. So some of it will be part of your basis. So you won't get taxed on that, but you'll get taxed on whatever part represents gains. And then, so you need to kind of think through that. And then once you know what's taxable, what the tax consequences are going to be, right? Because if we're literally talking about $65,000, there's probably going to be very little you're going to have a standard deduction at a minimum, right? So depending on your marital stat, your filing status, and all that, of course, you're assuming $15,000 in taxes, and if that's what you assume it is, let's just make that assumption. It's 15 grand. Then yeah, I mean, you got to fund that from somewhere. I'm not sure I'd put it in a high yield savings account. It depends, and I consult your tax preparer. I'm not a tax expert. In fact, you should just assume everything I say about taxes is wrong. But you may have to pay estimated taxes, right? And so, that would be 4 times a year. So you could talk to your tax accountant for that. Mine sends me a notice that says, Rob, get out the checkbook. It's time to pay Uncle Sam. I hate those emails. Hate them, but I heed them and I pay the taxes. So that's how I think about it. That's how I would walk through it. I'm not in that position yet, exactly, the one you described, but yeah, hopefully that's helpful. I mean, maybe there's a better way to do it. I don't know what it would be. So I'm sure smart people in the chat, if they have any better ideas, will let you know. So yeah, Kat wants to know my thoughts on bond ladder versus bond fund. Do your thoughts change for tips? Not really for me personally. I did the video today on building a tips ladder. If you haven't watched that and it's of interest to you, I think it was fun putting it together, and there's some tools that you can use that I walk through. But given our current situation plus my expected withdrawal rate, I just don't think I need to bother with a ladder. Where I might be more inclined to do it is if our withdrawal rate, were closer to 4%, and maybe there was I think the one area where I could see doing it in the right set of circumstances, if I was trying to bridge the gap between when I retired and when I would start claiming Social Security. And I covered that in the video, just on the assumption that there's a 5-year gap. You could build a 5-year tips ladder. I don't know that I would do that, because I'm very comfortable just having a mix of stocks and bonds in bond funds. Here's the thing. In a perfect world, we would only sell bonds and stocks when they're up, right? And so what some say would be, well, Rob, if you retire, you don't have any money set aside yet, and you retire, and then you go in to pull the money out for the first year of retirement, it could be a bad time to sell. Prices could be down, and you don't want to sell when the market's down. So shouldn't you have a cash cushion or a tips ladder? We could use that, right? Even if it just say 3 years. All right, well, let's imagine we do that. So I'm going to retire. We'll just use this example, a 3-year tips ladder. Good for me. I know exactly what I can expect. By the way, I don't know how many dollars I'll get back, right? Because I don't know what inflation will be. But I know that whatever they are, I'm going to get a real yield, an after inflation yield of whatever the yield is on those individual bonds or iShares tips ETF, right? I know what I'm going to get on an after inflation basis. So very, very predictable, probably as secure and guaranteed as we can get in this life, right? So, but let's fast forward now. I've spent through 1 year. I've got 2 years left on my tips ladder. Am I okay with that, or do I want to add a third? If I add a third, I've got to pull that money from somewhere. So I got to pull it from my stocks and bonds. Well, what if it's not a good time to do it, right? That's what we were trying to avoid in the first place, right? What if it's a bad time? And you could say, well, Rob, we got you. There's 2 years left on the tips ladder, so don't take anything out. All righty. Now we've got 1 year left. And do I extend the tips ladder or the cash cushion? What if it's still a bad time to take the money out? At some point, it seems to me, you're going to be taking the money out every year, whether you have a cash cushion or not. And if you try to sort of play the market, so to speak, and let your cash cushion significantly change over time because it's not a good time to pull money out, you then have to decide, okay, well, what qualifies as not a good time to take money out? Now, you could do that. You could come up with some objective, say if the market's down by X percent or whatever. I guess you could do it based on valuations. It strikes me as the kind of process that, one, I might let my own emotions get the better of me, or my own view of what the market will do in the next 6 to 12 months, and let that influence my decision, probably to results that I would not like. And so I just prefer, there's my stock bond mix. I'll probably keep about a year out just as an emergency fund. That never changes, but I'm basically pulling money out each year. It just seems to work better in my mind. And that's why I'm not a big fan of the 3-bucket strategy. I'm fine if someone has, like I have a 1 year emergency fund. That makes sense to me. I guess you could call that a 2-bucket strategy. That's how Mr. Avinsky, the father of the bucket strategy, views it. He's not a fan of the 3-bucket strategy. I'm not either, and for all of those reasons. So there you go. But now you might say, well, wait a minute, Rob, hold on. Then why in the world did you publish that video today about a tips ladder? Because the way I do it ain't the only way to do it. I'm not saying a tips ladder is unreasonable. You shouldn't do one. There you go. And I swear this is decaf. I feel kind of fired up today. I need to ask the group another question. I don't know what I'm going to ask you yet. Let's see here. Well, this is a fancy question from Rob Cathy. Within one admin, Fidelity, I guess within one broker, Fidelity, Schwab, Vanguard, is it a good idea to have redundant sector ETFs to reduce non-market risk? Example, for S&P 500, IVV, VU, and SPY in case one has an issue. Well, I don't know what issue they would have. You mean like fraud or something? I've never felt a need to have different ETFs that cover the same index because something might happen to one of them. I mean, I guess it doesn't hurt anything if that makes you feel more comfortable. I'm just trying to think, why I would need that. I can't think of a reason. But maybe I'm just not being imaginative enough. So Phil wants to know thoughts on VTIP, which is a tips fund, versus 5-year tip ladder. Well, I mean, here's the deal. With the ladder, with certainty on an after inflation basis what you're going to get, right? Even with shorter term funds, a mutual fund, it's, particularly with stocks, but you could even argue with a shorter term bond fund, it's like they're like a box of chocolate. You never know what you're going to get. I mean, the range of possibilities on a short-term tips fund is, of course, much narrower than, say, an S&P 500, right, where the range of possibilities, particularly over, say, a short period of a few years, the range of possibilities is quite large. But we can take a look at this. I mean, let's see here. That's a Vanguard fund, right? VTIP? Yeah, here it is. So real cheap, 4 basis points. What you want to know, so we know it's inflation protected bonds, right? We know it's going to be adjusted for inflation. So what do you want to know? I would want to know 2 things. I'd want to know the real yield, and I'd want to know the duration. So let's start with the duration. Why is Vanguard's site jumping around? Come on, Vanguard. Let's see here. I might have to go to Morningstar so that I know where to. I may have missed it, but we're still looking. We are still looking. Here we go. So the duration is about 2.5 years. That's really short. I mean, I think this is, if you're looking, the thing about here's the real difference that I guess, Phil, to answer your question, is that if you use the VTIP fund, of course it's easier, right? So it's one fund and you're done. But you've got to take money out of it, right? Let's just say once a year for the 5 years, right? Versus a 5-year ladder where whether it's that iShares ETF or individual tips, they're actually maturing at the end of each year, roughly. And so what's the difference? Well, the difference is when a bond matures, you're getting back the face value. Now, in the case of a tip, you're getting back, the value of the bond as adjusted for inflation. But you're not taking a haircut. There's on the day of maturity, there's no premium or discount, right? Boom, you get back what you expect to get back. With a fund, even one that's got a relatively short duration of, in this case, 2.5 years, when you go to sell it, or let's say 1/5 of it after year one, you may be selling at a discount, depending on whatever rates are doing. Now, because it's a relatively short duration, you're probably not going to be selling at some massive discount like you could be if it were a long-term bond fund. So you might say, well, I'll take that risk given just the simplicity of owning a fund. Okay, I would have no issues with that. And others might say, no, I want to know exactly. I don't want to take a discount. I just want to know what the situation is going to be. I'd rather just do the latter. So again, I don't think it's that one's right or wrong. They just have different pros and cons. By the way, you might say, well, wait a minute. What's the advantage of the fund apart from simplicity? Because you just described a situation where after year one, you sell at a discount. Well, you might sell at a premium, right? I mean, we don't know where interest rates are going to be. So in those 5 years, there may be times when you actually sell at a premium and do better. Again, it's a relatively short duration fund, so I wouldn't think the premium or discount would be that significant, but here's a good question. Does the Social Security Administration adjust each year's earnings for inflation when calculating the 35 years of earnings that it uses for the first year? I mean, I would assume it does, but honestly, I don't know. I could Google it. Can one of you Google it and answer that in the chat? It's a good question, Josh. It makes sense that they would, but I guess I don't know. Well, so Paul wants to know, he doesn't get the whole IRMAA, which is this extra amount you might be required to pay for Medicare if you have not too much, but based on how much taxable income you have. And it actually starts a couple years before 65. They look at it, they go back a couple of years to do the calculation. He said, for someone making $182,000, what's $67 a month? Well, I guess I have two answers to that. First of all, if it's all the same to you, I'll keep the $67. Thank you very much. But you're right. And if you compare $67 a month to $182,000, and we could look at the IRMAA numbers. I don't know if I can quickly find a website that IRMAA brackets. Let's see what we can find. Oh, here we go. Maybe. Yeah, so the premiums can actually get they can go up. Let me show you this. By the way, I have no idea if this information is accurate, but it was the first result in Google, so I got that going for me. And you said, what? Free tax cheat sheet. No, thank you. You put it at 182,000, so I guess it's right in here. Oh, that's individual. I'm not sure where the 182 comes from, but in any event, you can see how the premiums can go up significantly. Of course, this is a lot of money down here, but $560. But here's the deal. $1 of income over here, if it puts you into this level, increases your premium significantly. And so I think the issue for folks, Paul, is that if you're right on the cusp of either having to pay anything extra or go to that next level, it can be a pretty simple thing to try to reduce your taxable income just by a little to avoid that bump. And that's where software can help you, and or just a good tax preparer. But you got to plan ahead. You might say, well, I'll take some of my money out of a Roth this year to avoid that hit. So it could save you some money by just reducing your taxable income by a little bit. Now, I'm not 65 yet. I may look it, but I'm not. So I haven't actually had to figure all that out. It's a good question from John. In a retirement account, do qualified dividends get taxed differently as they would in a non-retirement account? No. So when the dividend gets paid and it's still in your 401k or IRA, there's no tax consequences at all. But when you pull it out, it's taxed as ordinary income, actually. Yeah. All right. So by the way, I'm now just to the thumbs up that you guys gave me when I started the show. And I think I'm working through this pretty quickly. I'm trying. Is there a Manning cast tonight? Did you see Ohio State beat Penn State? Huh? Any Penn State fans out there? Okay. I won't ask that. I don't know if it's tonight or not. Who's playing? Anyway, probably not important for our purposes. All right. Well, here's a good rap freak. What do you hope your legacy is? I don't know that to be honest, I don't know that I've thought a lot about it. I've thought a lot about, taking care of family, our children, granddaughter. But I don't know that I've thought about a legacy. I don't know. Maybe I should. I just want to get through today. By the way, I thought yoga, I hadn't gone in a week because I was at the conference. I thought I was going to die today in yoga. Whew, 90 minutes. And, so Bikram yoga, it's what I practice, I guess. 105 degrees. That's, what it should be. So this has never happened before. We're about an hour in. I've probably lost at least 12 pounds of, fluids. And some lady in the class on the other side of the room speaks up. And normally the students don't talk, right? The instructor does, walks you through the whole thing. But the students normally, don't talk. She says, Carol, the name of our instructor, she says, Carol, I'm cold. I'm like, what? I'm like, oh, I'm cold. Can you turn up the heat? And I'm thinking, are you kidding me? So our instructor, who's just wonderful, walks over to the thermostat that has a piece of paper over it that says, do not touch, right? Because, it's just inserted. She pulls it up. It's supposed to be 105. She pulls up the page. She goes, well, it's 109.7. She goes, but I'll turn it up for you. I'm like, are you kidding me? Anyway, I think I deviated from the question about my legacy. Yeah, I got bigger problems, rap freak. I got bigger problems than legacy. Maybe I should. I don't know. What would be an example of a legacy? Like, how would you think of a legacy? I don't know. So Quinn wants to know what I think of SPIAs, single premium immediate annuities, and do you own any, or do you plan a few? So I don't own any. I don't plan to buy any. I think so. The way a single premium immediate annuity works is you pay a chunk of money, and you get a set monthly payment for the rest of your life. I mean, there are variations on this. You can have ones that have a guaranteed income for like 10 years in case you buy the annuity, you walk out of the insurance company's offices and you get hit by a truck, right? So they can have somewhere you at least get paid for 10 years, or your family will at least get back what you paid in, or they have different. Of course, all of those bells and whistles cost money, which means for the same amount of money you'll get in exchange for those sort of guarantees, you get a smaller monthly amount. Nothing's free, right? I think SPIAs can be useful, particularly if you think in terms of maybe you've got Social Security And you want to cover at least a little bit more of your sort of fixed expenses than what Social Security covers. Actually, going back to the Bogleheads conference, I'd never heard this before. It's just sort of a rule of thumb that says you want to have 50% of sort of your fixed required expenses. These are expenses to just survive, covered by some form of guaranteed income. And so if Social Security and perhaps a pension doesn't get you up to at least 50%, buy an annuity to get the rest of the way up there. Now that's it's a rule of thumb. I think a lot depends on your circumstances. If you can live off of 1 or 2% of your nest egg, I mean, that's such a small amount. I just don't think you need effectively longevity insurance, which is effectively what an annuity contract, a SPIA, is. So I don't think there's any rule of thumb that will cover every situation, but it's one way to think about it, because that's always been my question. Conceptually, I can understand why you might want an annuity, and some will add to it. They'll say, if I have that, I'm more comfortable investing the rest of it maybe in more stocks than I might otherwise be, and I'd be more comfortable leaving it in the stock investments alone when the market goes down, and I'll spend a little more because if I don't have enough guaranteed income, you can tell me about the 4% rule all day long, but when the market's in trouble, I'm not spending, right? But you have no problem spending your Social Security check because another one's coming the next month. Well, unless the government shuts down, but we don't have to worry about that right now. Same thing with annuity. I'll spend the whole annuity because I get another check in the mail next month, and I think there's something to be said about that. The problem that I've always had is, okay, the devil's in the details. How much you're actually willing to put into an annuity, and how should you evaluate that, particularly given that annuities are not adjusted for inflation. So an annuity at age 65, isn't going to be worth nearly as much 20 years later. And that raises another question. At what age should you buy it? And, there's a lot of software that can help you with that. But you just have to keep in mind that the output of all these programs depends on the input, the assumptions you make, and so you say, well, I'll assume I'm going to be 100. All right. You get an answer. What if you don't live to be 100? I'll assume 95 or 90. You might get a different answer. So, I think it's going to take a lot of thought and maybe working with an advisor. In my case, I just don't think I'll buy an annuity. So I haven't had to think through those issues in any meaningful way for myself. I do plan, I've said this now for like a year, but I do want to have Wade Pfau on. Although I'm a little worried that he won't actually answer that question, not because he's being difficult, but because he can't. There's no real answer to it. And he did address it some at the Boglehead conference. Anyway. Thorin, I guess I'm pronouncing that right. What are your thoughts on employers and 401ks not depositing contributions for 401 account? Super frustrating. Sounds like fraudulent to me. It sounds illegal. There can be a delay. So that may be what you're talking about. But obviously, if they're withholding money from your paycheck and not putting it in the 401k, after I tried to deal with it myself with the employer, eventually I'd just get a lawyer. Yeah. That can be a problem. Now, Vinyl, that seems like a very negative sentiment. I feel like fast forwarding to the 11-minute mark. That'll teach you. All right. I am at 7:03 though, so he does have a point. All right. So some of these questions I've already covered, so that's good. I can skip some. So Richard says he has a 403B with Empower, and they offer those. I assume are those dimensional DFA funds, I assume. Let's take a look at one of them. What do we got? DFESX. Yeah, it's a DFA fund. I like DFA funds. I haven't looked at, VG. I guess just the first two are probably dimensional funds. Here it is, emerging markets. It's a little on the pricey side. But I mean, in a 401k, I probably wouldn't be put off by that necessarily. But having said that, to answer your question, if I could go with Schwab index funds, I probably would. Although you've got VGIAX, that's a Vanguard fund, right? Oh, it's not. It's Virtus Global Multi-Sector Income. Is that right? Well, that's VGI. Why did Morningstar bring up VGI when I typed in VGIAX? Because I mistyped it. Try it again. Oh, it's a Vanguard Growth and Income. Huh. This is what I get when I type it in. This isn't working, but it's not your fault. All right. Good job, Morningstar. Let's try it again. Wow. Morningstar, I broke Morningstar. I'll try it one more time. I think it's just that fund. In any event, I'd personally would probably go with the low cost index fund from Schwab over. I like some DFA funds, but I'm cheap. So yeah. Now, come on, Vinyl. There's more to this story. He says you can put $1 million in a money market fund and get $50,000 a year back. You can right now, today. FI Calc is free. To answer that question, this is the one I showed earlier. This one right here. So that's free. All right. This is an interesting question from Jesse. Is it true that bond funds like B&D carry lots of legacy investments? So let me first say I don't know what that means. That will perform worse than buying a 10-year treasury note or XTEN today. I don't know what XTEN is, but XTEN, maybe. That's a 10-year treasury. Oh, bond blocks. Yeah, it's 10-year. Let's see if we can get Morningstar to work. It did. So a couple of things to note. So B&D, so a 10-year treasury note, let's just use that for comparison. So first of all, it's a U.S. government bond, right? B&D, so we got two thumbs here. This is the 10-year treasury. That's what it is. It's a U.S. government bond with a maturity of 10 years. This thumb over here is B&D. It has treasuries, but it's also got corporate bonds, right? And some mortgage-backed securities. I think it even has some Yankee bonds, right? Bonds issued in other countries, but in U.S. dollars. Probably not a lot. I don't know what the percentage is. It doesn't have tips. But the point is, we're already comparing apples and oranges. Also, I don't know what the duration is on a 10-year treasury note today. Let me see if I can see on the fund you mentioned. It's 10 years. So this fund has an effective duration of 10 years. And so the interest rate risk is a bit higher on this fund than B&D. Doesn't make it better or worse, in my opinion. But if interest rates go up, this fund will lose more, all other things being equal, than B&D, because B&D's duration is noticeably shorter. Of course, if rates go down, the 10-year duration will cause that fund to go up higher. So, than the B&D. So I think they're similar investments, but significantly different. But B&D will return what it'll return. I don't know that legacy. I don't know what the legacy investment really means, but you can basically get a rough idea. As a rule of thumb, let me show you this. This is B&D. So its current yield is, we'll call it 5%, the SEC yield. So that's about what this fund will return over the next, call it 12 or 13 years. Basically, you take its duration of 6 years or 6.5, you double it and subtract 1. That's a very, very rough rule of thumb. But during that time, no matter what happens to price, it should return about 5%. And the reason that is, we all know if price goes up, the value of the fund goes down. But at the same time, as they're selling bonds, maybe those legacy investments you mentioned, they're putting that money into new purchases that they're making that have higher yields, and those higher yields will eventually make up for the losses. And if interest rates go down, and they because they're constantly buying and selling bonds to keep their duration at the range they're targeting. If interest rates go down, they might sell at a premium. That sounds good, but of course they're taking that money and reinvesting it in bonds that are paying a lower yield. So over time, they all sort of balance each other out. How long does that take? Well, there's some research that puts it at about 2 times duration minus 1. Again, I wouldn't view that as an exact science, but I think that's a rough. And it presents sort of an interesting, I guess, dilemma. On the one hand, folks say, bonds are driving me crazy because as interest rates go up, I have losses, so I don't want bonds. At the same time, people are saying, look at those yields. They're up. They're higher than they were, a lot higher than they were a year ago. I really like bonds. So what do? I just stick to my investment plan. Okay, I'm at 706 vinyl. I'm going to get past 710 if it kills me. And Nancy's question I already answered. I like the defined maturity bond by BlackRock as an alternative to individual tips. They got 10 years. So they're brand new, or maybe a month ago. So we'll see how they do. But 11 basis points, I think it is. 10 basis points, something like that. All right. So Todd wants to know about TLT for the long term. So the deal with TLT, we can pull it up here. This is the 20-year, right? Do I have that right? Or sometimes I get 20-year. So it's a 20-year treasury bond fund. It's a long-term bond fund. Current yield of 5%. If we look at the portfolio, it's going to have a duration of, drum roll, 16.5. So you're taking on significant interest rate risk. You're not taking on any credit risk, right? There's no risk of default. At least we assume that's true with the U.S. government. You can have your own opinions on that, but it's high credit risk, or it's high quality bond. But the interest rate risk is extensive. It falls into this, credit rating's high, that's good, but extensive interest rate risk because of the duration of the bonds, right? And so I think if you were to be a buy and hold investor and put that in a portfolio for 20 or 30 years, I think you'd probably be fine as long as you were willing to live through the good times and the bad. And the good times would be really good and the bad times would be really bad. I personally have not felt a need to do that with my bond portfolio, but that doesn't mean it's not, a reasonable approach. If you put it into Portfolio Visualizer, here's the one thing I will say. Actually, we're going to do this is important. So we'll do asset allocation. So we'll do let's see here. You know what we'll do? We'll just do long-term treasuries, and we'll do intermediate term treasuries. We're going to compare those two. You know what we'll do? And we'll compare T-bills. They may just call it short term. Let's see. Yeah, short term. Let's compare long-term, intermediate term, and short term. Here's what I believe is going to happen. I believe long-term will have the higher return. Depends how far back they have data. But I think both long and intermediate will significantly outperform short. The difference between long and intermediate, though, won't be as significant. But the volatility of long-term will be higher, making intermediate term, at least in my view, the sweet spot. Now, I've set myself up for failure. I could have analyzed this first and then pretended I knew what I was talking about. I probably should have done that. Anyway, let's look at the results. So we go back. You always want to, we've put in 72 to 23, which is the longest period you can for Portfolio Visualizer, but you always want to come here and see what data they have. So it's 78. So that's a long time. So yeah, so I think that's kind of what I said. 697 compound annual growth rate on long term versus 636 for intermediate. But look at the standard deviation, 1143 versus 6. That's huge difference. And then Short-term falls even more, but of course it's got a slightly lower standard deviation, or not slightly. It's this, it's roughly half, but still, you can see the difference here, and so it can be very difficult to stay in a long-term treasury fund, or individual bonds because of the volatility. I mean, look at the max drawdown, 42% versus 14. Worst year, 29 versus 10. I mean, it's a big difference. And so that's why I personally prefer, I like the better performance over intermediate terms over short term. I can handle the volatility difference, but not, when I go to long term, this volatility for that difference in growth is just not a good deal for me. Obviously, when you look at this over almost 50 years, the numbers look big, but anyway, that's my take on it. There you go. So Peter asked the question, I'm not sure I follow this. Let's see if we can puzzle this through. What percentage above your asset allocation would you take profits on short-term gain? Is it better to go above your asset allocation to get favored tax treatment? I guess, Peter, I need more context to help you with that one. I don't know based on that question. I'm sorry. So Raj wants to know how to invest as 10-year treasury yield tops 5%. I haven't changed how I invest, and I wouldn't. And I actually think it's very good not, you could look at this and say, well, wait a minute, let's go on the shorter term of the yield curve because yields are so high in the T-bills. You could go, say, well, I'm going to get out of BND or whatever total bond fund you might have and go with 10-year treasuries as they top 5%. I think long-term doing that's not going to help you. I think if you just stick with your approach, you're going to be just as well off. And if you start jumping into different, in different bonds based on where along the yield curve you think, is the best place to be, you're just as likely to get it wrong. And I think there's a real advantage to looking at all of this and saying, you know what, I'm going to stick to my plan because it's good. It's a good habit. And if I start to get out of bonds and jump into a different bond to chase the yield, all I'm doing is creating bad habits for myself that could hurt me down the road. So I haven't changed anything with the way I invest. Yeah. All right. So Quinn says that BlackRock on their ETF LifePath say they're tax efficient. I guess we'll see. Yeah. I mean, ETFs are tax efficient. Maybe they figured out a way to not distribute income on the bond portion of the portfolio. I don't know. All right. Magnificent Seven wants to know if tips and maybe a tips ladder, although that wasn't part of the question, are sort of a good alternative to a SPIA or some sort of fixed income annuity, which is not adjusted for inflation. It's an interesting question and something I've given some thought to. There are two issues here. So annuities not adjusted for inflation, right? That's the downside. Say tips or tip ladder, that we know, of course, it is by definition. So the advantage goes to tips. But let's take a 30-year tips ladder. It stops at year 30, right? Assuming you're spending all the money as you go, you're done. You got no money left after 30 years, whereas an annuity lasts until you die. I don't know what other guidance I can give you beyond pointing that out. Yeah. I will say this, you do have to think about longevity risk, right? What if I live to be 100? I don't know that you need to think beyond that. Yes, it's possible. Maybe one of you will live to be 110, but whatever the number is, I do think we need to figure out how we'll deal financially if we live to be 100 or whatever. that doesn't necessarily mean you need an annuity or a tips ladder. I mean, maybe Social Security, will be enough, or your withdrawal rate from your investments is so low that coupled with Social Security is sufficient, particularly if you delay claiming Social Security until you're 70, or maybe you do need to buy at least to some amount of a fixed annuity, right? But I do think it's good to say, how will I take care of myself, my family financially if I live or my spouse lives to be 100? But it doesn't mean you have to do it all, right? I would start with Social Security. That's the first thing. And by that, I mean, waiting as long as you can. Certainly the higher earner generally should probably wait till 70. Then I would look at my investments and my withdrawal rate. If I can keep it at 2 or 2.5%, I know a lot of people can't, then you probably are, in my opinion, you're probably pretty good from a longevity perspective. But maybe you're at 3.5 or 4%. So maybe, you can look at possibly annuitizing some of the portfolio, possibly. And I kind of think of it step by step. That's one of the things that troubles me with some software is they want you to assume, you'll live to be whatever, 100, and then it evaluates everything with that assumption. So of course it puts you into an annuity. You're going to live to be 100, right? Of course it tells you to hold off on Social Security till you're 70. You're going to live to be 100. Of course it tells you not to spend as much from your nest egg because you're going to live to be 100. And I'm just not sure assuming that for every single piece of analysis makes the most sense. But I'm not, breaking it out sort of step by step does get complicated. So it's more about thinking it through than having some piece of software that's going to magically answer that question for you. Obviously, they can help you. Anyway. Mike wants me to come to Austin, Texas. I was there 2 years ago for FinCon. Next year, it's in Atlanta. I would love to come to Austin and Minneapolis. So the thing about Minneapolis that's cool is you can, like in the dead of winter, you can walk downtown without ever walking outside. You've got these bridges that span the different buildings, and they're like a little city unto themselves. Although it's been a while since I've been to Minneapolis. Oh, now an invite to New York City. I love New York City. There's 3 for 3. All right. So here's a question from FKT about CFPs versus CFAs. If you're looking for planning, I think it's a certified financial planner is what you want, not a chartered financial analyst, right? Yeah. CFAs, could talk about how to invest, but you got to be careful because some of them, excuse me, have some crazy ideas on how to invest, in my opinion. Not all of them. Of course, some CFPs have some crazy ideas as well. Certainly from a planning perspective, I would go with a CFP. I don't know why. I don't know that I would hire a CFA. I mean, if there's a CFP that also happens to be a chartered financial analyst, that's perfectly fine. I think Rick Ferry's a chartered financial analyst. But I don't know why I would hire someone who's just a CFA. Maybe there's a good reason. I don't know. Fast Eddie wants to know how I liked Ohio State versus Penn State. Loved it. I have a very good friend that went to Penn State, and every year we have a wager, and the loser, the team, whoever loses, the winner buys the loser lunch. The idea is, you lost, but at least you get a free lunch out of it. I got to tell you, I'm losing money hand over fist on this deal. He's probably not watching tonight, but Kelly, if you are, man, lunch is on me. All right. Yeah. So John points out, he goes, I've seen all these charts about what happens if you miss the 10 best days in the market. What if you miss the 10 worst days? If you miss the 10 worst days, I'm sure your performance would improve substantially. I don't know of a chart that says that. I mean, I think the takeaway from these sorts of things is just stay in the market. The interesting thing, though, is that you'll often find really bad days close to really good days. They kind of happen oftentimes together. But in any event, I don't know of a chart either. All right. By the way, Vinyl, I'm at 722, so I think you owe me an apology. Although this will be close enough. Vinyl says most of what you say about taxes is correct. I'll take that. I should there's my legacy right there. I like that. Rob was mostly correct. That seems fair. All right. What do we got next? How are we doing on time? Is it 8:05? Wow. Jonathan wants to know, is it smart to take gains in my taxable account to increase the cost basis? So you're going to sell, you get taxed, and I guess buy back. And so, okay, I might be just under the threshold for 0% next year and can't find a reason not to. I confess, maybe it's late. Maybe I should have had caffeine. I'm not fully following that, Jonathan. So I don't have an answer to your question, I'm afraid. You guys are asking some tough ones. It is late. I'm doing the best I can here. Here's what Phil says. What financial advisor category would you go to minimize taxes? As follows. 1, this is like a law school exam, the multi-state or something. No income is needed from the portfolio. Okay. Complex tax picture. 100K, I'm going to guess, of income, plus RMDs in 2 years, 2 rental properties. Well, I would go to a tax expert. I'd go to a tax, CPA that does taxes. Is what probably for that, I think. I mean, you'll find financial planners that do taxes as well. In fact, let me just show you something here. So if you go to low-cost financial, if you Google low-cost financial advisor, my site's on the first page of Google. I think I could have this wrong, but Jack I met last year at Bogleheads. I don't think he was there this year. Let's see if his website works. There he is. I think he does taxes as well. Well, there he is in a video. By the way, I'm not recommending him. You need to do your due diligence. Service and fees. Yeah, it's so it's $2,500 upfront cost and then $6,500 per year thereafter. So it's a flat fee. Obviously, it might be relevant to someone depending on how much assets you have. Yeah, preparing and filing your income taxes every year. I thought he did taxes, although there's double asterisks. What's that mean? Oh, some people want to do their own taxes. So you will find, I don't know if he's, if Jack's the right solution. I'm not suggesting that, but you will find financial planners that do your taxes as well as part of the fee. Yeah, Mike says, I don't think in terms of a safe withdrawal rate. I'll be using a variable withdrawal with guardrails. I just don't believe that a fixed safe withdrawal rate is of much use or truly safe. I agree with you. I mean, I think the 4% rule is good for planning, but I don't think it's really a good, it's called a constant. Really, we should, unfortunately, the 4% rule is what we call it. What we should call it is a constant dollar withdrawal rate. Constant dollar meaning constant on an after inflation basis. And why do I say that? You might say, well, aren't you just splitting hairs, Rob? I mean, they've done the math, and it turns out that a constant dollar can support 4%. So what's your problem? My problem is that a constant dollar withdrawal rate doesn't support a 4% rule unless you make all the same assumptions that Bill Bingen made in one paper in 1994. If you start to assume different things, different asset classes, different fees, assets outside of the United States, when you're going to retire. He assumed you retire at the end of the year. He looked at it on an annual basis. Look at it quarterly, which he did in a subsequent paper. Safe withdrawal rate actually comes down a smidge. Look at it on a monthly basis, with which Big Earn did at Early Retirement Now. I think that's the name of the site. Yeah. It comes down even more. So there is no one safe withdrawal rate for a constant dollar approach. Even if we assume we're going to use historical data to do the analysis, it's going to depend on a host of assumptions that we're going to make, right? Also, he was assuming 30 years. You may need to assume more or less, or would it be fewer? I think it'd be fewer. If my mom's watching, she will immediately put the answer in chat. Pretty sure it's fewer. Okay. I'm now lost. I have no idea where I am. So Ed wants to know if New Retirement or Empower include taxes and estimates of what you need to retire. I don't know about Empower, but what New Retirement does is you put in your expenses, not taxes, all the other expenses, and you can do it, category by category or just as one big number. And then based on what you're pulling out of what type of account, it will determine your tax liability. And that's, I think, more or less how most retirement planning tools work. Empower is a little different. And to be honest, I don't know off the top of my head how Empower deals with taxes. I don't know. It's a good question. I would look it up, but it'd probably take me longer than we have to feel comfortable with an answer to that. Ed, this is a tax question. Vinyl, you need to let me know if I get this right. Is there a difference in how a loss in long-term gains versus short-term gains impact your tax bill? I'm going to say, I don't think so. And what I mean by that is, they say you offset long-term gains with long-term losses and short-term gains with short-term losses. But if you have leftover, you can offset one against the other. It doesn't really matter. So again, you should assume I get the taxes wrong. But I don't, like if you had, let's say you had long-term and short-term gains, but you only had long-term losses, let's just say. I think you have to offset the long-term gains first with those losses. So I guess if you didn't have enough to cover the short-term gains, it could, right? Because your short-term gains are going to be taxed as ordinary income. But let's assume you had plenty of long-term gain losses. You could offset the long-term gains first, and then if you had enough, all of your short-term gains. I believe that's how it works. Vinyl says yes, but it is very complicated. There you go. That's Vinyl's answer. All right. So in terms of the tips ladder video, Dan, I didn't distinguish between Roth and a traditional, say, IRA. I would generally put tips in a traditional IRA and leave my Roth for stocks would be my approach. I want the Roth to become as fat as a tick, as I like to say, and that's going to happen with stocks, at least over the long term. It's a reasonable approach. All right. Mike Rogers, it was great meeting you at FinCon. You too. I'm trying to think, how many people did I meet at FinCon that watched this show? I don't know. Probably more at Bogleheads conference. I don't know that it matters. I'm just trying to fill some dead air time. Here's a good question. Steve says, Rob, what is the best way to meet you? I don't know. I come to Cincinnati area often from Chicago. Well, I'm not in Ohio, Steve. Now, I used to be. And you might think I'm from Ohio or live in Ohio, given the Buckeyes and the footballs back here. But I now live near Washington, D.C. Although I do come to Ohio, although I don't get to Cincinnati very often. I don't know. I could do meetups. Part of it, I would need one of you to like plan them. I don't want to plan anything. Just tell me where to go, where to show up. I'd be open to that. I don't know. Do you guys want to plan? Oh, that reminds me. I'm going to ask you guys a question. I meant to ask this. I'm going to do this as a Q&A. I think this will work. What should we call our group? We need to give our group a name. Are we freedom fighters? A lot of people have said Bogleheads, which is, of course, a play on Bogleheads. I don't know. I'm just going to say that I'm going to put this out there. What are we going to call our group? What are you guys called? Are we freedom fighters? I don't know. So let's start this Q&A. I don't know how this works. We'll see what happens. I think I've done that right. I don't normally do the Q&A feature of YouTube. So you'll see it there or you won't. Freedom fighter. Okay, here it comes in. Freedom fighters. You say it at the beginning of every video. Yep. Okay. We'll see what else comes in. Okay. By the way, Vinyl, I'm at 7:31. I don't want to rub it in or anything. Oh, Jason just bought my book. Well, thank you. Retire Before Mom and Dad. I heard a funny story. One of the folks at FinCon who does coaching said she lost a client because they told her they'd read my book and didn't need her. She laughed at that. I did too. All right. Yeah, so Mike, this is I think this is a sweet spot for retirement. I'm a hybrid investor with a floor of guaranteed income from Social Security, pension, and annuities for expenses and total returns for discretionary spending. Yeah, I like that approach. Seems pretty solid. All right. All right. Jim, does a healthy 78-year-old investor with a hefty I bond holding need tips as much as a 30-year-old? Well, I don't know that a 30-year-old honestly needs tips or I bonds. I don't think they're a mistake as part of the bond portfolio at all. But as a 78-year-old, I mean, I bonds protect you from inflation as well. Because you have to buy them directly from the government, they're not you can't buy them as part of an ETF, as you could with what we were looking at with iShares. There's a limit to how much you can buy. They can be difficult to incorporate into a sort of an overall asset allocation plan, but of course you can do it if you just over time, buy more and more I bonds. The thing that I would be concerned with I bonds is, do you own any that have the fixed rate of 0%, right? Because that's not going to do you any good, and that would concern me. But putting that issue aside, I mean, I bonds protect you from inflation. I mean, they do it in a different way than tips, but you get that inflation protection through the inflation rate, the variable rate that changes every 6 months. Again, of course, I guess they've already got the number out for November, right? I assume they do. I haven't actually looked at it. The fixed rate comes out usually here early November. So if you've got an I bond holding that's consistent with what you want for your overall portfolio, and that gives you some inflation, protection against inflation, I don't know that you need tips. I mean, long term stocks are actually a good, I guess I'll say hedge against inflation. So is real estate, but long term. In the short term, they can get ugly. All right. Robbers. We're going to call ourselves the robbers? I don't know. Burgermeisters. I don't know. Financial freedom fighters. I like that. Burger Bites, really? Oh, F Cube. So there's two for financial freedom fighters, the Buckeyes. Ed just goes right to it, the Buckeyes. That could get a little confusing. All right. Okay, now we're getting to the good questions. Do you typically use the same 2 or 3 chess openings? And if so, what are they? Well, it depends, Jesse. Are you a chess player and you're trying to learn my secrets? So as white, I have played d4 openings, but largely I play e4. By the way, if you're not a chess player, just tune out for 60 seconds. Against e5, I play the Italian. Against the Sicilian, I've been playing c3, the Alpin. Against the French or the Caro-Kann, I usually play an advanced version where I push e5. Those are probably the primary. I mean, there are other openings, of course, that black can play against e4, but those are sort of the primary ones. As black against d4, I play the semi-Slav. And against e4, I play e5. And of course, it just depends on what white does. But if they play the Ruy Lopez, I play the Marshall Gambit. If they play the Italian, I just pretty much straightforward response from black. I usually play an early a6 and drop my black bishop to a7. Yeah, there you go. Sorry about that for everyone else. I'm sure that was like, what? What's wrong with you? Okay. Well, I mean, you can get a rough idea, right? And so there's still ways to address that, but you're right. I mean, I didn't know that. But even so, I mean, I assume they're going to, are IRMAAs, I assume they're adjusted for inflation. Yeah, from CPIU. So, I mean, you could still, I think, have a pretty good idea, but depending on your circumstances, it may or may not be worth bothering. Depending on, I mean, you may have income that either you just know it's not going to be an issue, or either because you're well under it or well over it, or you could have income where you're sort of in the middle of it, and you might have to do the best you can. And they are 2 years in arrears. That is true. All right. So the question of municipal bonds from James, are they worth it in a 10% tax state? Well, it does depend on your tax bracket, but remember, so with a muni, you're not paying federal income tax. You may not pay state income tax. Depends on where you live and what the municipal bonds, fund or bonds you're buying. If you're buying, for the larger states, like say California, you can get a California fund, or New York. For some states like Virginia, I don't think there's enough for them to have a fund that I know of anyway. And so what you just have to compare. So with municipal bonds, because of the tax breaks, you're going to get a lower yield. And so you just have to compare that to, say, an alternative, treasuries or a bond fund, and figure out what your we're talking about taxable accounts here, right? What your after-tax yield will be on those other types of bond funds, and then compare it to the yield you'd get on the municipal bond. Just a question of math, and figure out what makes the most sense. Now, that's not the only issue to consider. Municipal bond funds have different risks involved. Now, I've never personally viewed municipal bonds as particularly risky, but there are different kinds of municipal bonds, right? I mean, some of them, revenue bonds, will, they're paid out from the revenue of whatever they're building. They're building something that's going to generate revenue, and that's what pays the bonds, versus, taxes on the folks that live in that state or whatever. So there can be different risks. I mean, certainly I would say municipal bonds are riskier than treasuries. So, it's not just a question of taxes. But yeah, you just have to look at what the after-tax yield will be for the alternatives and compare it to the municipal bonds. I've owned municipal bonds in the past or bond fund. I don't now. I just don't have any bonds I have in a taxable account or T-bills. And it's just basically for money we're going to spend here in the next 12 months. All right. So why do I like multiple brokerage accounts? It's simply because of the risk of, some sort of hacking event, or, I need some money and I don't know, website's down. I can't get into a site. Again, you might say these risks are not significant, but I haven't found it overly complicated to have a couple of brokerage accounts. And it just makes me more comfortable to know my money's not all at one place. So yeah, that's really it. Oh, okay. What keyboard do I use? Well, this one, the clickety clack, is it an F96? Yeah, it's an F96. Can I get that to focus? And the name of it is iQunix, IQUNIX. I can show it to you on the screen here. You might be able to get this on Amazon. I don't know. But yeah, here's the website. In fact, that's my keyboard right there. This is an F97, so it might be a newer model because I've had this for a while. This one over here, which I don't know if you can you see? You probably can't even see this one. This is just a gaming. I don't really care for this keyboard. It's just a gaming one that I bought for the PC. Yeah. We're down to 4 minutes to go. Mike wants to know if Steve Martin is my long lost brother. I guess I kind of. I've heard a couple of. I've heard Steve Martin. I've heard Anderson Cooper. When I was a kid, it was Huey Lewis. When I say a kid, like 20. If I just had the talent of any one of those three, that would be nice. But it's a whole other issue. Oh, free online advisors. If you just Google low cost financial advisor, you'll find it on the first page of Google. But you can also just Google, I guess, all of that. I need to not redesign, but restructure the links on this site so that things are easier to find. And that is on my to-do list. All right. Josh, I'm sorry for your loss. All right. What else do we have? It's funny, I'm catching up now to the hot yoga comments. Well, the thing about hot yoga, actually, I much prefer it, and I've done both. But I'm not very flexible. I'm working on it. And the heat and the humidity actually, help sort of loosen your muscles, and I'm much more flexible, in the hot room, as they call it. And part of that for me is just, I think it actually reduces the risk of injury. Now, I don't know if that's scientific or not, but let's see. I'm gonna skip down. I think I did pretty good tonight. I don't know. Well, let me go back to the question here. Do you have any more? So not a ton of responses. I've got to be honest. I'm a little disappointed, but it looks like financial freedom fighters. Well, I want to give that some more thought. I'm going to end the Q&A. That Q&A. I guess you've got some here too. Oh, here's VJ. So we had a good chance to catch up at the Boglehead conference. The Burger Boomers. I like it. Burgers Bandits. Okay. I think there's a lot of financial freedom fighters. So yeah, a lot of F3 or F cubed. What's this? Are the Vikings playing? What happened? Is this Kirk Cousins? I mean, what's going on? Did he get hurt? What happened? What's the date today? The 23rd, 4th? It's Vikings. Did he get hurt? I don't know. I guess I'll have to tune in. Or maybe you're just saying he's playing. 2 minutes into the game. No, what happened? Kirk Cousins, not Kurt. I don't know. I guess I'll have to watch. It is 8:30. I do want to, I'll scroll down to the bottom. Go freedom, never against it. Let's see. What's we are not all boomers. That's a good point, Charlie. We're not all boomers. Are we fighting for financial freedom or against it? I'm fighting for it, Vinyl. I don't know. George wants to know about a video I did with Empower and all its features. I don't know that I've actually done, like I did one for new retirement that was fairly extensive. And actually what I did for that one, it was a live show and like people could join. It was like a working session where we're all got our new retirement thing up and we're working through it. And I'm open to that if that's of interest to folks. I don't know if I've done a full review sort of Empower. I'm happy to do one. But let me just double check. Can I be honest? For my presentation at FinCon, which was about YouTube, I went through a lot of the old stuff I'd done. And I forgot half of it. I'd forgotten that I interviewed Christine Benz from Morningstar. Don't tell her. Of course, it was a couple of years ago, and I'm getting old. So if I'd have done something on Empower, it would have probably been when it was called Personal Capital. So if you go to the channel and you search Personal Capital, you will see one from about a year ago, and I'll show it to you. It's this one. So Personal Capital Retirement Planner Review and User's Guide. It's 25 minutes. So you might check that out. That was when I had my old setup. I kind of miss it. All right. Well, it's 8:32, so I'm going to call it a night. Thanks for tuning in. I hope you have a great week. I will have some more videos out this week. I hope, Lord willing, and the creek don't rise. And will I be back in 2 weeks? Let me just take a quick look-see. Got to check my calendar. Very busy. Yeah, I should be. Again, life can happen, but yeah, it looks like 2 weeks from now, which is November 6th, if you can believe it, should be back with another live Q&A. So until then, remember, the best thing money can buy is financial freedom.